So what's a balance sheet? A balance sheet is a picture of what you have and what you owe at one point in time. So it would list all your assets, all you owned, your cash, your accounts receivable, your inventory, your equipment, buildings, anything you have. And also it's going to list also what you owe. So you don't find you owe all these assets, but you've got to pay for them. So if you haven't paid your vendors, for example, then you have to show that also that you owe money to your vendors, to the bank. You owe money to your employees, maybe. So that's asset liabilities, and then what falls out is the equity, what you own, the actual net worth.
Yes.
So that's your balance sheet. It's a picture at one point in time of what you own, your net worth.
I like saying it's a snapshot just
That's
because
what
like
it
it's
is.
at that exact moment and that can change from the morning to the evening. Um, so in theory, this sounds pretty simple. But as you know, and I know, we would not have jobs if it was that easy. So I think we're just going to start just going through the assets. And I think we should start with cash because I think that's a big ticket item that everyone thinks they get right. But as you're going to tell us, they don't.
That's right. That's
Yeah.
right. Yeah, people still have a misconception of, these days people use mostly QuickBooks. So
Mhm.
you think that you just push a button and QuickBooks is going to tell you how much money you have. Well, no, that's not the way it works. You've got to make sure that, for QuickBooks to tell you the right number, you have to input the information correctly in your software. So
Okay.
you've got to record all your disbursements, all your receipts, and after that you have to reconcile everything. So at the end of the month, you're supposed to do your monthly close, and you should look into the bank balance. Does it make sense? You have to reconcile it with the bank. So you get a bank statement, but the bank statement doesn't really tell you how much money you have. It tells you how much money is beside your name at the bank, but it doesn't consider that if you have checks in the mail or stuff like that, then you may not have as much money as you think as the bank statement says. So you've got to do a bank reconciliation. What's a bank reconciliation? The bank
Exactly.
reconciliation. I knew you were going to ask me.
I
So,
know. Don't take my part.
so a bank reconciliation will start with the bank balance because that's your starting point. It's from a third party. It tells you how much you have. But then from there, you have to reduce the amount by any check that are outstanding that have been cashed by your vendors, if you have any deposits and transits, and that kind of thing. So make sure you do a bank reconciliation to make sure that you actually know how much you have at that one point in time in the balance sheet. Um, I was talking about QuickBooks earlier because most people use QuickBooks. So QuickBooks has a module for bank reconciliation, but don't always believe it. You've got to check it because I've seen, people give you a bank reconciliation, and actually the reconciled balance doesn't tie to the book. So you've got to make sure that it works out. So you got to check. You got to check. You don't
You have
just
to
push
do
a
your
button.
homework. You don't just get to believe the system.
Exactly. Exactly.
Shocking. Shocking. I think on that same note of bank reconciliations, we've talked about this before, but there's a lot of confusion around cash or accrual, and it comes to cash. But I think we've talked about this. It doesn't matter. Is that right?
That's correct. Yeah. A lot of people use cash basis rather than accrual, but cash is cash. So the cash balance is going to be the same either if you use accrual basis of accounting or if you use cash basis of accounting. So
And
there's no difference.
and I'm
You're correct.
assuming this comes into play a lot at the end of the year, when people are trying to accelerate some expenses and maybe hold off on some checks.
What? What? Yes.
Okay,
Yeah. People
so
people would put check in the mail at the last minute. You have to get a deduction, which is fine. It's totally fine.
right, but as long as it's included in your bank's reconciliation, because it won't necessarily hit your bank statement.
That's right. That's right.
Okay.
Yes, that is correct.
So for everyone
Yeah.
listening, if you're not doing your reconciliations, you're actually missing out on deductions, which is not what we want here.
Actually, there's a lot of PTE payments right here. PTE payments that are made at the last minute, the very last minute on December 31st. So it doesn't show up on your bank statement, but hey, you made the payment, you want a deduction. So make sure that you actually reconcile your bank and the payment is reflected in
Yeah, I don't know anyone who did that. So yeah.
there.
Moving on our asset list, this is kind of a hot topic, especially when we're talking about cash to accrual. We have accounts receivable. So can we go into what accounts receivable is and the typical mishaps that you see there?
Yes, accounts receivable is the amount of money that your customers owe you because you did something for them. You either send them a product, widgets, or you perform services for them. So it's accounts receivable, they owe you the money. you got to make sure you record these amounts that are owed to you because you got to keep track and be able to follow up on them. I do have clients who just like send invoices and they don't keep track of. I send an invoice, so I should expect like $1,000 payment from this customer, but they don't keep track of it. So they don't know that if the $1,000 doesn't come in, that they have to make a phone call to say, "Hey, where's my money?" So
Right.
you got to keep track. You got to make sure that you record all your accounts receivable. Um,
So go ahead. Sorry.
no, that's fine. So also, when you get payments, just because I see that often, when you get payments from the customer, you need to apply that payment to the correct invoice, to the correct customer, because otherwise you won't be able to know who owes you money at a certain point in time. So you can make these follow-up calls.
So I think part of that is like you can't just have a pot of accounts receivable. You just can't hit that same account. It needs to be actually classified, is what you're saying.
That is
Okay.
correct. Yeah, yeah. It has to be assigned to your specific customers.
And then is there a process or something that you see typically in terms of when someone should be recording that accounts receivable amount?
Yeah, there's a revenue recognition standard, different rules on when you actually the money is owed to you. As an example, if you get a check in the mail because somebody wants a product, but you haven't shipped the product yet because they just prepay you, well, that's not revenue, so that's not receivable, or that doesn't go against receivable. So in order to be owed money, you need to do something. You need to either perform a service or you need to ship product or something. So
Okay,
this is when it's actually accounts receivable is earned and it
great.
belongs it belongs on your balance sheet.
And I know on the other side of accounts receivable, we have maybe some bad debt or looking at and analyzing your accounts. So what does that kind of look like and what do you see happen constantly there?
Okay, so at the end of a period, at the end of every month, I guess you should do that. You should look at your accounts receivable and see if they're collectible. As I said earlier, you want to make phone calls and try to collect them, but some people can't pay you because they have money problems or something, and you still extended credits to them because you want to be nice or for whatever reason. But at the end of the period, at the end of the month, or at the end of the year, you should really look at your list and okay, so is there anything that I'm not going to collect? And if you cannot collect the amount, then you should take either a reserve or you should, if it's like a lost cause, you will just write off the receivable. And in order to get a deduction for tax, if you're on an accrual basis, then you would have to write it off. If there's a chance you're still going to collect it, then it's only a reserve that you will take. And in that case, it's going to be tax deductible.
In terms of determining whether something's collectible or not, is there any type of guidelines surrounding that, or is it kind of a judgment call?
No, there's no real guidelines. It really depends on the industry of your customers, and it's really like specific customers. If somebody has a history of paying you after like 60 or 90 days, they're slow payers, but you've dealt with them before. You know they will pay you, so it's not a bad debt. It's not a bad receivable. So it really depends on specific customers. But if somebody used to pay you within 30 days, all of a sudden it's 90 days later, they haven't paid you, but maybe there's a problem. So you should look into it. So it's really case by case.
Case by case. And then does it vary by industry as well? Is that something that kind of is there an industry standard that people can look at?
And it's well, like, for example, in the food industry, if you talk about a restaurant, usually
Hmm.
you collect your receivable. Well, it's more on the vendor side. If you sell to restaurants, you will
Okay,
collect your money right away. I mean, when you ship product, when you ship produce or meat
I
or
would hope
whatever,
so.
you get paid right on the spot. Otherwise, you may not get it. So I guess in this that would be like the kind of industry. It could tell you, how fast your customers are paying, but it's really customer by customer. It's really your own experience of your own customers. I wouldn't say it's really industry wide here.
And so in this same line, how often should you be looking at your AR aging and kind of, trimming that down, really understanding where you're at with your collections?
Well, I mean, you have to clean your books at the end of every period, which is usually people will close their books once a month.
Right.
But I would be wrong to tell you that you should look at your receivable only once a month. You should look at your receivable all the time because you want to collect your receivable. So it's really a daily thing. You should enter your billings into your accounts receivable module every time you send a bill or every batch, probably every day.
Would you say that the majority of the time, your accounts receivable is overstated on financials that you've seen in the past, or is it understated?
It's usually overstated because people bill and they don't collect and they forget to follow up and the account gets bad. It's usually it's an overstatement rather than an understatement.
So there's kind
Yeah.
of end of year cleanup that happens that should be happening more monthly.
It should be happening more periodically, yeah, more timely, I would say.
And taking
Yes.
off your auditor hat for a second, just putting on your accountant hat, would you say that people have a more likelihood of collecting the more on top of it they are, or does it usually end up working in their advantage just collecting at the end of the year?
Oh no. Well, I guess if you want to reduce your taxable income, right, and you're on a cash basis, then you're not going to be taxed on until you collect the money. But no, no, collect your receivable right away. You have a way better chance to collect on a new receivable on a new account than if it's 6 months old or a long time that people forget about it and your customers aren't going to pay you. They
Okay,
forgot that they owe you
so
money.
for anyone listening with a guy over 25 years of experience, because he helps with the collectibles here too, he's telling you make sure that you're looking at it monthly and following up. And I know we touched on this a little bit, but I wanted to go back to revenue recognition for a second, just because it ties so much into AI. And I know when we've talked about this previously, you said it's very complicated and there's 5 steps surrounding it. But I really would like to talk about like when we're recording and when we're releasing, I guess, when that AR should be recorded, especially if you're in the manufacturing or any type of goods.
Well, okay, so you should record an accounts receivable, or it's considered earned when you actually did what you were supposed to do.
Okay.
So if you're selling a product, then it's when it's shipped, and if it's you're doing a service, it's when you perform the service. So when
Okay.
the other party gets the benefit of what you did for them.
Okay.
So you've got to perform because of the performance obligations. You
Okay.
have to perform what you're supposed to do in order to earn the receivable, in order to earn the revenue. And that's only at that time it's going to be called the receivable.
Maybe that's fair. I think where I want to head into the direction of I know that in the past, inventory and inventory counts are huge for audit, and I wanted to kind of talk about the issues you see surrounding inventory because that kind of ties into revenue. So,
That's true. Inventory, well, very often. So inventory is supposed to be stated at the lower of cost or net realizable value.
okay,
So if you think that if your inventory is good, then it should be at cost. Whatever you paid for it is what you should maintain it in your books until you sell it. Then you sell it, then you just take it off the books and recognize it as revenue. Um, the what is the cost? The cost is what you pay for it, but it also includes the shipping that you pay to get the product into your warehouse. That's part of your cost. So, but that's the basic. Like if you are a distributor, for example, or you retail, that if you buy a product and then you take it and you sell it, you don't
right,
do anything. For manufacturing companies, it's a little different. Well, it's very different actually, because they do a lot, and you have to capitalize all kinds of costs to your inventory. The raw material. Then after that, you play with it. You do whatever you're supposed to do. You've got direct labor involved.
hmm
You've got to capitalize that. You've got to include that as part of your custom inventory. Then you've got overhead also that is related to your plant, your manufacturing plant. That also gets capitalized to your inventory. So that's more complicated for manufacturing companies.
right. And I think you touched on this word earlier, but we know that depending on how a contract is written, when should inventory be necessarily taken off your balance sheet? So we know that there's different terms. We have FOB shipping and FOB destination. What does that actually mean, and how are you properly recording?
Yes. Okay. So FOB shipping is it when it leaves your warehouse, it's shipping it shipped from there to your client. Then at the time that it leaves your warehouse, it's deemed to be revenue, to be gone, to be your customer's responsibility. And the other one is FOB destination when the in transit, while it's the product is going from your warehouse to the customer, en route, it belongs to you still until it gets there. And it's only when it gets there that it's considered revenue, and you can go to receivable and you actually take out the inventory. A good way to think about it for inventory is, okay, so what if your place burns down, or something happens? Who's responsible for whose insurance is going to pay for it? So if it's your
Um,
insurance, then it's yours.
okay.
If the other party's insurance, then it's theirs.
Is
That's how I
that
think
is
about it.
that dictated by contract? Is that a company standard? How does that normally work?
It's actually a contract between you
Okay.
and your customer. Yeah, yeah, you have to have an understanding. You and your customer, or you and the supplier, depending on which way is it coming or is it leaving.
And
But
we
it's
talked,
by contract.
it's by contract. Okay. So people should be paying more attention to their commonly
Yeah.
written contracts. Okay. And in your experience, have you seen that kind of become an issue? I know thinking about it, that would be huge problems at month end and year end. depending on how your contract is written, it could grossly change your inventory count. Yeah,
Yeah, yeah.
significantly.
Well, that is true. That is true because, as you said, so at the end of the year, you're supposed to count your inventory, count your products.
Right.
So this is a good like reconciling method to make sure that you everything is there, doesn't get stolen and that kind of thing. But if you take a count on December 31st, let's say, and it's not there, you don't. It's not there. It's uncounted. But
Right.
you might still have something that is on the way, on the truck that is going to your customer. If you have FOB destination, for example. So even if you didn't count it, well, it still belong to you because it's on the way there, and because of the contract says FOB destination, then you're supposed to include it in inventory.
And speaking of counting, I know that while we're dealing with manufacturing specifically, we have work in progress. And I wanted to see what WIP looks like, what mishaps you've seen around that.
Oh my goodness, that's a hard one because you have to have standard costs, and you've got to. It's for the manufacturing company again. This is when you deal with raw material, labor and overhead. If you have a product that you're doing that takes a few days, let's say, as a process to go from beginning to end before it's ready to be shipped, before it's ready to be commercialized, then you've got to say, okay, I'm only halfway done in what I'm supposed to do. So WIP would be basically only take part of the labor that has been incurred so far and the overhead that would relate to that labor. It's
Got it.
basically
Okay.
between raw material and finished goods. It's somewhere in the middle, somewhere in between.
Would you say
So it's
that people lack good systems in place? Would you say, where does that really fall? Like, where does the issue really fall?
it's always an issue. It's always an issue. But it's very complicated. I mean, you have to keep track of everything. It's really hard.
Right.
You got some software that will help you, but
Okay.
I mean, yeah, when you talk about WIP and finished goods in a manufacturing company, it's really confusing and it's complicated.
And that's
It
fair.
is.
And switching gears to a much easier topic, and we'll probably wrap up AR with this. We talked about earlier for a non-manufacturing, non-good company, just really simply, if you're a service company like we are, when do you record? And when can you pick and choose when to record? How does that work? I mean, we have FOB shipping and FOB destination for, manufacturing. Is there something similar for a service industry?
Service is very different. It's really it's usually based on a percentage of completion, depending on your contract again. If you're hired to do a project for a company, let's say you do design for something like an architect or something, and you're halfway done, then if you know you're going to get paid at the end, you can recognize half of your
Okay.
of the revenue. So you would have an accounts receivable for half of it. Or actually, it depends on how the reports are written. But you have half an asset. You have an asset. It
Okay.
could be either receivable or I guess you could call it inventory or work in progress. I guess you could call it that way. But yeah, for a service company, it's really based on where you're at in the process of performing your obligation, performing whatever you're supposed to do.
Is there a hard and fast rule around that, or is it more of just like putting your thumb up and seeing where you're at with the project?
Well, no, you're supposed to have a systematic or systemic. I never know how to say this. But where you're at, it has to make the way of measuring the progress has to make sense.
Okay. And
So
uniform.
people will usually use labor hours. That's
Okay.
usually what people use, but there are different methods
Oh,
of
that
doing
makes
it.
sense. All right,
Yeah.
switching gears from AR, let's talk about on our asset side, prepaid expenses. One of my favorite topics.
What's that?
What is a prepaid expense? Tell me about it.
Yeah, people often forget to account for that. The best example is probably insurance. Like you have a policy that will go from July 1st to June 30th, and today's December 31st. Well, you paid all the premium, but you only halfway through your contract. So because you paid everything, you have half of what you paid should be prepaid.
Right.
Because for the last 6 months of the contract, it hasn't been incurred yet. So that's a prepaid expense. That's what it is. So usually you see it in taxes and in insurance. Those are the most common ones.
That's fair. And then on that same note, and again, we're going to keep bringing this up for our cash to accrual or accrual people. What does this mean if I'm cash basis? What does this mean if you're accrual? How does that come into play?
For book, if you are accrual, then as I said, you have to have
You're
a
done.
prepaid expense for
Right.
half of it. In
Hmm.
my example for insurance, but if you're on a cash basis, hey, you paid the cash, you paid the entire premium, so therefore it's an expense. You would have mostly for tax, I guess, when you
Yeah.
use cash basis. But yeah, that's what it's cash. So cash is when you lay out the cash, and accrual is more like thinking about matching revenue and expenses, and where are we in the process.
And is there a hybrid of the two that you see? What do you see most often? I mean, I guess people would most likely be on accrual basis when they're coming to you on your
Well,
side.
yeah, I mean, for the bigger the company is, the bigger the entity is, it's the chances are they're going to be an accrual because this is what GAAP, generally accepted accounting principle. It's accrual. You have to do an accrual. But if you have a small business that doesn't require financial reports to be given to third parties, very often they'll do just maintain their books on a cash basis.
Got it.
So
Okay.
usually the smaller companies are going to use cash, and bigger companies are going to use accrual.
Fair.
We
Totally
see
fair.
both, but we do see something in the middle. There's something called modified cash basis of accounting.
Okay.
So this is like, you're halfway there. You will record your receivable and payable, but you won't record your prepaid, for example.
Got it.
That's would
Okay.
be modified cash. So it's somewhere in the middle.
And I would say probably most people have, if you're so and so cash basis, you're most likely modified cash. Because otherwise, how do you know what you're collecting and what you owe? There'd be really
That's
no
right.
way. Yeah.
Most
Okay.
people, yeah, most people, yeah. I mean, pure cash is. I've never seen pure cash. Pure cash would mean like you buy a building and you pay cash. You wouldn't expense a building. That'd be pure cash. You never see that. It's
Well, and
always
I don't think you can in the age of credit cards and Venmo and Zelle. Like I don't know that you can have pure cash anymore.
that's right.
Yeah.
Yeah, that's right.
I don't know that it works that
Okay.
way. Moving on our asset side, we have fixed assets. And I know we've talked about this because we go back and forth about what should be expensed and capitalized. So let's talk about fixed assets for a second and what they usually entail.
Fixed assets are usually bigger pieces of equipment, bigger purchases. That's going to be for equipment, building a car, something that will last you for more than a year.
Okay.
So you will be able to use it for more than a year. So you, instead of expensing it right away, then you will capitalize it, put in your balance sheet, and then you will like chip at it as you go, like as you use your, let's say your car is you can use it for 5 years. So
Hmm.
you will expense your car over 5 years. So you expense it over the economic life of the assets. And
And
then
just
this is what happened with property and equipment with fixed assets.
and just to be clear, there's no outside of depreciation portion, there's no real option to just immediately expense it, correct? It needs to be capitalized. This isn't an optional, like I want to or I don't want to.
No, no, no. This is, you're supposed to capitalize. If it's something that will last you for more than a year, you should capitalize it. I mean, we have to be practical though. I mean, there are thresholds, and
Okay.
you probably have the same thing. I know you work in tax, so you probably have the same kind of threshold. I mean, if I buy I don't know, what can I buy? Something that is like that will last me like 2 years, but it's kind of cheap. Like computers are pretty cheap these days. You'll buy a computer and you pay $500 for it, but you know it's going to last you 3 years. Well, you're not going to capitalize $500 in most entities. $500 is nothing, right? It's not much money.
Right.
So instead of like putting it there and keeping track of it and amortizing it, it's not practical. Just expense it. So if it's a small amount, it's always based on a dollar amount and a threshold that you will establish that makes sense for you for your business. And below this threshold, just expense it. Even though it would last you for longer, just expense it because it's more practical.
I will tell you from the tax side, we do have a pretty hard rule of under 2,500, you can go ahead and expense. So I mean, if
Okay.
that lines up kind of what you're saying, I would highly recommend to anyone out there that's looking at their financials, if you have any expenses that are over 2,500, take a second look at it. But anything that you're putting on your asset section, if it is under 2,500, you get the luck of expensing it that year. So don't make anyone else's life harder, namely your tax professionals, by keeping it on your balance sheet, unless there's a
That makes
specific
sense.
reason around it. Yeah, I would definitely
Okay.
say that.
Yeah.
So I think we've covered the assets, unless there's anything else that you wanted to talk about, uh, that you've seen with assets that are just huge red flags for you.
I could go on and on for
You can
a
go on as
day
long as
talking
you would
about
like to.
it. That's okay.
Okay, well, in that case, we're going to switch over to the liabilities. And everyone that's listening, we do have a Q&A portion. I do see some questions that are in there, and we'll get to them. This one, I think, had a little bit more to do with liabilities, and it's a bit complicated. So I'm going to wait a little bit more towards the end. But I do see
Okay.
you. I'm not ignoring them. But as we move into liabilities, we're going to do the antithesis of AR, which is our AP. So let's talk about accounts payable.
All right. Oh, well, accounts payable is what you owe your vendors. So if you owe money to somebody, you should record that you owe money to somebody. So again, it's the same as accounts receivable. You've got to keep track of it. You want to make sure you pay them, because if you don't pay them, you're going to be in bad terms with your vendors, and you want your vendors to be happy because you want them to give you credit. So take care of your vendors.
Take care of your vendors.
That's true.
And concerning what you see normally when AP comes through, is that usually overstated or understated? And why do you think that happens?
Oh, AP it's almost always understated.
Shocking.
People forget that they owe
So
money, right?
AR is
Nobody
always
wants.
overstated and AP is always understated. I'm so surprised.
What a coincidence, yeah. Yeah, usually it's people forget to accrue to accounts payable for like regular invoices. It's probably easier because as people get invoices in the mail or email, they will record their accounts payable. Although very often you're gonna order something, you're gonna get a piece of equipment or a piece of something in your warehouse, but you won't get the invoice until a few days later. So in that case, sometimes people will forget to record invoices at a certain date, but invoices are usually pretty okay. What people forget is accruals. What you have to accrue. The main one is actually, guess, the payroll. If you have a payroll, let's say you get paid every 2 weeks, and let's talk about December 31st year end. And so you had a payroll on December 25th. The next one's going to be on January 6th or whatever.
Okay.
Or whatever.
That's fine. It works.
Around there. Okay. So you should accrue for half of your payroll.
Right.
The check you're going to pay on December 5th, well, half of it relates to last year. So you should accrue for that as a liability. You owe the money to your employees. So
Right.
yeah, accrual. So accruals. Another one is PTO. People forget. I don't know how many people forget about PTOs, but if PTO is paid time off, accrued vacation, if you think about it this way, if your employees are going to leave on December 31st, do you owe them accrued vacation? If you owe them vacation, then you need to accrue for it, even though they're not leaving, but you
Right.
should accrue. So people forget to accrue PTO like very often.
I know that we talked about this, but California has specific rules surrounding that, right, for PTO?
Well, you still California.
Was it
It's
California? I think it was
actually I'm
California.
not sure. I'm not sure, but I mean, it depends on your policies. And some people have unlimited PTOs.
Hmm.
Unlimited PTOs actually, if the employee leaves, you actually have no obligation to pay. So therefore, this is not liability, and you just like record as you go. And when you take vacation, it just lets uh, a regular payroll. So you wouldn't have to accrue for that. You
Actually,
probably talk about holidays,
uh-huh.
and no, not
No, no,
holidays.
no. Actually, I just remembered what I was talking about.
Okay.
So I know that California automatically pays out PTO if you have accrued it, but there are some states that you actually have to ask for your PTO from your employer. So I think probably recording it there. That's the conversation I was having actually with another partner here,
Okay.
Karen. Yeah, so she was telling me that in New York, actually, you are required to, upon submitting like your 2 weeks or whatever it is, actually ask to be paid out your PTO. And if you don't specifically ask, they don't actually have to pay you. So that would
Oh
actually be
God.
interesting. Yeah, just a tidbit for those of us out there. But yeah, so that would actually be interesting in terms of recording too, because when do you actually record? I mean, you have to record as it accrues, but it would be interesting to see how that changes if the person leaves without getting paid out. So
Interesting.
yeah, the more you know. So anyone living and working
Yeah.
in New York, keep an eye
I
open.
learned I learned something today.
Oh, wow. I know that we're going to quickly back up into AP really quick. I know that we talked about the difference between recording when we receive the invoice and recording when we do the work. And I just want to reiterate, it is most proper to be record or when we receive the invoice and when we owe it. I just want to reiterate, the most proper way to record AP is when the immediacy of when you owe it, not necessarily when you receive the invoice. Is that correct?
That is correct. That's
Okay.
correct. I mean, it's much easier. I mean, you report your payable when you get the invoice, but after
Right.
that, look to see if it does it make is it right? Because I mean, most cases when you get the invoice, you owe the money.
Right.
It
Okay.
is in most cases.
So I
But
guess I'm going to ask you a complicated question. So
yeah,
don't be upset. But for example, like as us for a service company, so people will call us and maybe we're having like 2 to 3 hour phone calls. We have the consulting side of it, and our invoices go out once a month at the end of the month. Well, I guess the beginning of the next month, somewhere in the beginning of the next month. When we are as the client who's received the services that owe it, when we're reconciling our books at the end of the month, should that already be including the services that we have already rendered as the provider that they owe, or do they have to wait for the invoice? That's where it gets a little sticky for me.
It is, yeah. I mean, in theory, they owe the money because the service has been rendered. So, and
Okay.
the fact that you send the invoice just let's say like the 15th,
Solidifies it.
the 15th of January. Well, I mean, it's kind of sad, because they have to know and they want to close. If they want to close their books real fast, they want to know how much they owe you. They know they owe you something. They don't know how much.
Right.
So they will estimate it, but it is a payable. If you've incurred the time as a professional and you rendered services for them, they have to, they owe you the money. So you would have to accrue something.
And this is my my non-auditing hat showing, but is there anything in GAAP surrounding those rules that people need to adhere to, or is that just basically it? Record it when it's incurred.
Why you're supposed to record when it's incurred. Sometimes you have to make estimates because you don't get the invoice until a few days later or several days later, but you're supposed to record an accrual for that.
And we touched upon our accrued expenses already. I don't think we need to harp on that anymore. But moving on our liabilities list, we have loans with officers. And I know we talked about this. What do you typically see? How does that typically work?
Loan
What are the
officers, I
problems?
mean, problems. Well, loan officers very often don't have, they're not in writing. There's no
Right,
note supporting them. But we have to look at what are the terms, what are repayment terms, because we have to either classify them as either current liabilities or long-term liabilities. If it's going to be paid, if we think it's going to be paid within 1 year, it's called the current liability. And
right.
if it's whenever we have money to pay, then that would probably be in long term. You have to kind of determine when it's going to get paid. But loan to officer, I mean, usually there's no real, there's no covenant, like the bank would
Right.
have covenant, you have some requirements. So I guess loan to officers is easier with that respect. But
Less
that's,
paperwork. But I would say I think a typical problem that we see, at least on the tax side, is maybe people not accruing interest, misapplying payments. Is that true across the board for loan amounts? What do you typically see around that?
yes, actually, yeah, that's correct. With a bank, it's not as bad or as problematic because you get a statement from the bank, so you know how much you owe them. But you're correct. When people make a payment, they apply it very often against the liability against the loan balance. Well, you forget there's an interest portion to it. So what you should do is when you make a payment, you should affect the interest expense and for the remaining you could reduce the amount of the loan. But yeah, you're correct. You very often you see problems between allocating interest and principal payments.
So maybe that at the end of the year, the loan balance would be understated because they've actually put the interest expense against the principal. Is that
That is
correct?
correct.
Okay.
That is correct. So what you do is just get your loan statement and match it with your balance sheet.
I
It's
mean,
easy.
that sounds pretty, yeah, that sounds great, except we have our officer loans. And I guess that's another question. And I think we've talked about this on the tax side a lot, especially with our S Corp uh clients. Can you have a loan from an officer without accruing interest?
Actually, I believe you could, because for GAAP purposes,
Hmm.
because if there's no due date, the loan could be due tomorrow, so you don't really have to accrue interest because you don't know if you can actually incur it. So there's in terms of when there's no due date and it's considered short term, you don't have to. Let me try to think about this. You don't have. Well, no, I'm talking about imputing interest when you do a present value. I'm thinking about. So that's not the same thing. So could you have loan without? Well, you could have loan without interest. Yes, you could.
Okay.
Yeah.
I would say from the other side, I think that there is a treasury rule in terms of having loans even between families outside of businesses, that there needs to be a minimal amount of interest charge, but I think that'd have to be written into your contract. So maybe there is something different within loans for shareholders and loans from
That could be,
officers.
but you might be thinking about loan receivable. Maybe you don't
Both
want it
ways,
to
I
be
think. Both
considered
ways.
distribution. That's probably what it is, isn't
There's that too, but also payables as well.
it? Okay. Okay.
I think we're gonna go ahead and try to tackle this question. Stephane, I don't know if you can see it or if you want me to read it to you. It is a little bit lengthy,
I
but
don't
I'm
see it. Well, maybe if I go to the chat.
at the bottom it says Q&A, so if you want to press
Yes.
it, and I'll read it out loud while you look at it.
Okay.
So we have a question from our audience. It says there is a company called Chewy. their financial statements confuse me for a couple of reasons. They say that they have no debt and they have much liquidity, but in their latest filing, the difference between current liabilities and current assets is actually a negative 300 million at
Okay.
MRQ at market versus negative 200 million at the same time. And it seems that their payables exceed their receivables and inventory is about 200 million. So at almost half of their
It's
460
confusing.
million cash balance appears to be leveraging their vendors. And the same company, they claim no debt, but they have capital lease operating lease obligations of over 460 million. So isn't this a form of financing? Most analysts on the street seem to treat it as debt. Okay, let's break this up
Wow,
because I see a couple different questions in
wow.
here. Thank you, Warren, for the question. But let's break it out. So Stephane, you can see it,
Yes,
Stephane?
yes.
Okay.
Oh, call me Warren. Call me after.
I think you could we're gonna yeah, that one is a little bit I mean we can talk about
That's
leveraging their vendors. I think we can talk about that phrase a little bit on here. Oh, we have hold on. He responded. He said he's
waiting
happy
for
to
me
call
for
you.
me. Yeah, okay, wait, thank you.
Um, I guess we can talk about operating lease obligations though, because those are kind of interesting.
Oh yeah, that's right. There's a new rule, but it's about
Hmm.
2 years old now. That if you have an operating lease, you have a lease for your premises, you're supposed to, well, you have to, if you want to follow GAAP, you have to put in your balance sheet. So all your future payments are going to be recorded as a liability, and then the counterpart to it is going to be a right of use asset. So this is a fairly
Okay.
new rule, but it made a huge impact on the balance sheets. It doesn't change the amount of expense. It doesn't
Okay.
change the P&L, but it does change the way the balance sheet looks. And actually, it did create problems with ratios and bank covenants because the bank covenants and the ratios that were established when people took their loans that was not in the picture. So I mean that changed the look of a balance sheet and it changed all the ratios. So it was problematic for a little while. But now it's been about 2 years, so it's starting to get better.
Well, what would you say in terms of mishaps that you've seen with this as they've, fairly new, 2 years is still something that you're getting used to. What would you say is the biggest issue with this?
People don't know about it, so they don't report
That's
it.
fair.
That's really it's not
Yeah, no, that's
there.
fair. That's totally an honest and good answer.
Yeah,
Um,
the other thing, but the other thing here that is actually complicated or it's subjective is that if you have an option to extend your lease, or let's say you have a 5 year lease, or
okay,
an option to extend for 5 years, you're supposed to analyze, am I going to extend or not? And if you are going to extend for the additional 5 years, you have to put 10 years of liability on your balance sheet. So
interesting. Okay.
it's very subjective.
Yeah, that sounds tricky to
It
say the
is, it
least.
is.
Yeah. So I think we're ready to leave the liability section unless you have something else you want to add that you typically see.
No, I don't think so.
And I'm going to shoot back up because I know that before we get to equity, which is my favorite topic, before we get to equity, let's shoot back up to assets. And I don't think we really talked about any issues that we typically see with fixed assets. Something from our side, at least when we get the financials and tax, sometimes what we see is assets that no longer exist, still on the balance sheet. Maybe an obsolete asset, something that was given up. Is there anything that you typically see that's an accounting mishap that I would say around fixed assets other than trying to capitalize the $300 item?
Pieces that are missing, you're saying?
We'll have some clients, no, that they're continuing being on their balance sheet for a very long
Oh,
time, but maybe say that it's, somehow the desk that they capitalized a long time ago is just still
okay, I
sitting there
see.
when they've moved
Oh,
offices and you're
yeah.
like, that doesn't exist anymore. Like, let's clean it up. Is that
Yes,
something
yes,
that you
yeah.
typically see too?
Oh, we see that all the time. Yes, yes. So yeah, try to clean up your list. Well, usually you should have a list of fixed asset with the cost
Mhm.
on the side to make sure it balances with your, the balance of this account in your GL. And if you get rid of a desk, like you're saying, just write it off. Because if you leave it there, be careful, you might have to pay property tax on it too. So you really, I mean, there's an
Correct.
incentive to
There's multiple.
clean your fixed asset. Yeah, there's a lot of reasons why you want to do that. Also, I mean, for book and tax, sometimes the depreciation methods are not the same. So if you really get rid of something, you might be able to get more deductions on the tax side. So you should clean your list.
Warren, hello again. You're asking about zombie assets. Thank you for your questions. I enjoy them. Zombie assets. What about Section 179 write-offs for things like cars and trucks that don't get put into fixed assets? I had some tax advisors get aggressive on 179. Those would still actually be listed, or on the tax side at least, you would be listed on your fixed asset information. So they're written off in the sense that they are no longer having value on your balance sheet, but that doesn't mean that they no longer exist. So I guess that would be that zombie asset. It is still there. It has been fully depreciated. However, there are rules surrounding that. If you are ridding yourself of the fixed asset within its life, so you have aggressively depreciated that asset before that life is actually over, you do have to go ahead and what we have depreciation recapture, that still stands true for either bonus or for 179. So you do still have to be careful. So that's why that's that zombie asset term. It's really not dead. It's really not alive. It has no value to you, but it still holds value until that life is over. Um, there are people that are aggressive with their bonus and 179 deductions. I don't see a problem with that, as long as you're uniform with your treatment of your assets, and actually like take advantage while you can, accelerate that expense if you want to. But talking about fixed assets and the depreciation, you can't pick and choose which accounting method you use. There actually is on the tax side, something that you actually need to stick to, and it's a uniformity of accounting. So if you are going to change how you're depreciating under a different system, this is makers to acres, not necessarily with 179. You will actually have to file a form for it. And sorry, we went really tax right there, but I wanted to just answer that question.
That's
Um,
complicated.
yeah, so it was a good one. But yes, so we're talking about that with your fixed assets. I think what we'll see, and we talked about this, is clients tend to not think about, even with their cars. I see this the most. Maybe they'll trade in a car. They don't put the value of the old car. They don't really change out their balance sheet. So I would just, anyone listening, make sure that you're checking out your fixed assets and making sure that you're doing a good job cleaning those up. Don't leave deductions on the table, I guess would be the great way to put it.
Let me chime in here, though. What I
Sure.
say when we talk about cleaning your list of fixed assets, if a fixed asset is fully depreciated, that doesn't mean that it should be taken out of the list, because
No,
if
no,
it's
no,
still
no.
there
This is stuff that isn't
physically,
there.
if
Yeah.
it's still there physically, you should keep it on your list. If it's gone, if you got rid of it, you put it in the trash, then it should get up the list.
Right,
It's
exactly.
really
So if
physical.
it's
Is it physical exists? Is it there or not?
right. And that's like kind of goes into our conversation earlier, really having that de minimis threshold. You don't want to be chasing keyboards. You really want to make sure that when you're presenting your balance sheet, you're doing it for those things that are lasting more than a year, that are of substantial value. So again, for the tax side, we have a de minimis of 2,500. Um, However your company policy is, go ahead and go with it. But I would definitely say that that should be at least your minimum should be, if it's under 2,500, it can be expensed in that year. Yes. Okay, let's move on to equity. My favorite topic, Stefan, your favorite topic too. So let's talk about what equity is.
Well, equity is your net worth. It's what belongs to you. Like we talked about, balance sheet is asset, what you own versus what you owe. So if you own more than what you owe, then you worth something, you got something of value. That's your equity. That's basically your net worth.
Great.
The difference between asset and liabilities. That's what it is.
Yeah, it kind of is that middle ground. Equity also includes net income for the year. So that kind of what I've seen a lot of the issues surrounding that. Again, if anything in your income statement is overstated or understated, therefore your AP or AR, that directly affects your equity portion. So your net worth can fluctuate as you are overstating or understating. So this is kind of like that catch-all area, I think.
I guess you could like look at it this way. I mean, it's basically what, aside from what you put in when you create when you fund the company,
Hmm.
it's really the earnings of the company that you haven't distributed out. So this is why it's called retained earnings. So the earnings that are retained in the company. So that's what equity is. You made money and you left it there as opposed to take it out.
And I think from my side, and I know I would love for you to comment on this, for all of our balance sheet, we have people, or how do I explain this? There are times in the current year that you found out that something that should have been recorded in a prior year hasn't been recorded. And for us, at least, we see what are like prior period adjustments, and they end up in the equity section. Can you talk a little bit about that and what the correct treatment is and how you would do that?
Yeah, I mean, it does happen. People
Mhm.
forget something, and we find that there was a mistake made in prior year, which would result in a prior period adjustment. But sometimes be careful when you do this, because that gets so confusing. It changes everything, and when you give your set of books or your package to your accountant, then we try to reconcile with the prior year, and it doesn't work. So be very upfront with it. Communicate if you think there was a mistake made in a prior year that you want to correct. That's fine. It happens. But let's just be upfront about it and let's talk about it because it does create headaches. But I mean, people make mistakes and it happens.
I think we kind of talked about this when you and I were just chatting, but uh, for us, equity is always our section that we know that you touch something that maybe you shouldn't have. Can we talk about what it means when books are closed and what you should do if you find those mistakes that happen in a prior year?
If your books are closed, they're closed. Don't touch them. I think there's a function in QuickBooks where you can
You can
close it
lock it.
and you can lock it. Okay,
You can,
that's
yeah,
so you can go back because I mean, so often we will get a package like we prepare a tax return or a financial statement, and after that the company received another invoice from the prior year. They record it as an invoice from the prior year. They will change the numbers from the prior year, and then it gets all like confusing and a big mess. So when you close the books, when you send your package, when the tax return is filed, it's closed. Do not touch prior year. If you have an invoice that you think should belong to the year before, but the return has been done, give us a call or put in the new year and tell us about it. That's my recommendation.
I also recommend that. And I will say, for anyone listening, when we are what we end up seeing, because we actually look at the GL on the tax side, as Stephane knows, we look at the GL just because we actually have to have information as to the change in balances, especially when it comes to fixed assets, if there's loans, whatever the changes are. When we see journal entries recorded against, AR, that then hit equity, those are not necessarily, that doesn't provide congruency with our prior year tax returns. So what we'll end up doing is we have to do a little bit of an analysis, and you talked about this. The first thing we all do is we check our ending balances of what we had the previous year and the beginning balances of what we had for this year, and do they make sense? So every time I will say, if you're trying to bury something or hide it in the prior year, you're going to be found out this year. So there's no need to do that. Just work with your accountant on correcting it. There's no need to, if you forgot to record an invoice, if there's, an account, your income should have been higher last year, your expenses should have been higher. We can push that into the current year when it's found. Trying to adjust your books for a prior year is going to cause an issue, a huge issue. So anyone listening, don't do it. I think nothing makes me more sad is when I'm looking and we have our completed tax return, and I'm sure you feel the same way with your financials. When it's done, and then you go back and you're like, what did you do? And now you have to find it. So I think for anyone listening, especially when it hits equity, because that's again the catch-all that kind of ends up happening to make your balance sheet balance when you're making these adjustments, you will be found. And I think that's a mishap, at least on our side. I'm sure it's a mishap on yours as well.
Yeah, you see
Yeah.
that.
Equity is my favorite place because it's where you find everything. And I know we can talk a little bit about, I don't know if you want to talk a little bit about stock and the valuation of that and how it should be recorded, but you don't have to if you don't want to.
The stock, I mean, we're talking mostly about private companies. The stock
Yes.
is you go at par value.
Okay.
But it basically is the amount of money that people put in on day one. And
Hmm.
after that, I guess there are more investors for a corporation I'm talking about.
Correct.
So common stock goes at par value. And if it's par value at $1, but you paid $5, then it's going to be $1 in common stock and $4 in additional paid in capital.
Great.
And the other component of equity is going to be retained earnings that we talked about earlier. But
Awesome.
that's pretty much it.
As long as you don't see any issues with it, then I think we're good to go.
No, there's not that many. No, we don't see issues very often with common stock. I mean, it happens, but not that much. So we're good there.
Great. So I think if no one else has any additional questions, I think Warren will be giving you a call because he has more questions. If no one has any
That's
additional
good.
questions, Stephane, thank you so much for being here. We'll give it a minute more in case anyone wants to type into the chat. But thank you so much for answering this. And overall, is there any advice that you'd like to give people as they're on their accounting journeys earlier in the year? So we have plenty of time to make sure that we're fixing anything before year end.
Let's just prevent problems. If you have questions or something, just pick up the phone and call us. So it's always better to get it right from the start. So be open about it and communicate with us.
Awesome. Okay. Well, I think we are good to go. Thank you so much. And we'll see you next month.
Thank you.
Thanks, Stephane.